for a motor vehicle dealer to sell you a car and then never give you the title. Well, that's illegal. And you can claim the bond to seek reimbursement for that loss. So you gave them a down payment of 10 grand for that car, and you can claim the bond to seek reimbursement for the 10 grand that you lost out on because they never gave you the title for the car.
Jackson, let's pretend that Mr. Jason knows nothing about surety, and you were going to explain it to him. How would you walk him through that?
Absolutely. Luckily, with surety, you'll have someone that's going to be coming to you with, I need this bond, like I need X, Y, or Z. And what I usually will start with is, okay, well, this person's coming to you, what's the industry that they're in? Are they an auto dealer? Are they in construction? Are they in financial services? Are they a mortgage broker or mortgage lender? And from there, it's who's requiring this bond of them? What's the point of the obligation? So you'll have a lot of these state or city or county requirements that will come up, and those folks will actually say, hey, XYZ contractor, you need to have a $25,000 bond if you want to do business in the state of California. Or in Arizona, you're a residential builder, you need a $5,000 bond requirement. Boom, go. So those are my two big questions first is, what industry are you in and who's requiring the bond? From there, we can kind of get a better understanding of, all right, what's the bond amount? And then what is the underwriting information that we need to be able to process this quote for you? A lot of these bonds, they're underwritten based off of the soft credit check, kind of parse through the, hey, I need a social security number. A lot of folks don't want to give that to you. But there is a way to go about that process where, you're providing them with some of that comfort, some of that really understanding that you're here, you know what you're doing, and that you're there to provide them with a service and some help.
What's the best ways to navigate through that part of the conversation?
When we do that, I would always let them know basically, hey, it's a soft credit check. It's not going to affect your credit anyway. And that, this gets stored in a secure location that's encrypted. Once it's in there, I can't see it. So it's there. I can see what it returns for me to be able to underwrite the account. Other than that, it's tied away and it's gone.
Is it like other bonds, forms of bond? Do they, with a 25,000, is there somebody that's investing 25,000 on the other side of the bond, or it's through the company?
Yes, with surety, it's this three-party obligation, right? So traditional insurance, two-party, you've got the insured and the carrier. With surety, you have the principal, which is the insured or your customer. You have the surety company, which provides the financial backing. And then you have the obligee, which is the state, city, county project owner for your payment performance bonds that is requiring the bond of the principal. Let's say for a motor vehicle dealer to sell you a car and then never give you the title. Well, that's illegal. And you can claim the bond to seek reimbursement for that loss. So you gave them a down payment of 10 grand for that car, and you can claim the bond to seek reimbursement for the 10 grand that you lost out on because they never gave you the title for the car. So it's a protection for the consumer for fraud and unethical behavior. It's a protection for taxpayers when it comes to these large payment performance bonds for federally funded construction work. Anytime a contractor walks off of a job or they do something that violates the terms of their contract, they go over time to complete on the contract and never actually finish the project. Well, a bond can be claimed to provide protection to the project owner in those cases.
It's insurance. It's just not called insurance. It's called a bond.
Exactly. Yeah. It's not a protection for the principal for your customer. It's a protection for the consumers that interact with that customer.
It's interesting. I wonder why they called it bond, because bond is a financial instrument,
right?
Debt, right? So
exactly, and that's one of the reasons I think it really throws our the agents that we work with. It can really throw them for a loop because it's a lot different than any other product that they're dealing with. There's no other product that they have that's hey, I've got this weird 3-party requirement. I don't know why I have a 3-party requirement. I just have a customer that needs to get this taken care of. How can you help?
Right. So this is a front end, you could, if marketed properly, an agency could utilize this as kind of a front end offer, right? It's a lower ticket, something that everybody a lot of businesses may need. Mm-hmm. So if you're marketing for this, you use this as the foot in the door and then go after the GL, the commercial auto, their personal and everything else.
Oh, absolutely. And that's one of the big things with the surety that I see is, while it's not the biggest ticket item, it's really not. I think average premiums for us, $400 or $500. It's not breaking the bank, right? But it creates a really sticky relationship because the underwriting and the information that you need for it, generally it's a little more personal information. Like you're getting social security number. In some cases, you may need a personal financial statement or a business financial statement. You know, some things that folks generally like to hold closer to the chest.
What industries pay out the highest commissions on bonds? Like who needs the biggest bond? Are all the commissions for all the bonds the same, or
Sure.
do some pay out more? Like if I was gonna sell bonds today,
I would tell you to try to attack the biggest markets, right? I would start there, and it's going to be construction, it's going to be the auto industry, transportation, financial services, so like mortgage brokers, mortgage lenders, money transmitters. As far as the commission ranges, I mean, I see differentiation more on standard versus non-standard types of business. So like I can place this with maybe an admitted market, right, and get a standard commission anywhere like 20-30%. If I place this with something that's not admitted or have to go to a substandard market for it, well, it may be a little bit lower. But yeah, I would definitely, construction's gonna be the big one. That's probably like 60% of the market when you look at just from a premium volume perspective.
how much are those premiums?
A couple $100,000 in premium, and then you've written a ton of them that are like 10-15,000 in premium. And you'll have some that are a couple grand. It just kind of depends on what those project sizes are, what relationships you've established with those agents, and the agents, what they've established with those contractors.
There it is.
Jackson.
Awesome.
Thanks, Jackson.
Thank you guys.
Here we go,
Talk to you
man.
soon. Thanks so much. Y'all have a good one. Bye, y'all.